Good morning and good afternoon, or whatever time zone you're in. Welcome. It's a great pleasure to welcome you all to today's webinar on financial institutions' use of big data and alternative data to provide products and services. This is our second webinar in the Banking on Data, Great Possibilities, Great Responsibilities series, co-hosted by the FDIC and Santa Clara University's Levy School of Business. This partnership brings together the financial, regulatory, and policy sector on the East Coast with the tech sector on the West Coast. The goal of our webinar series is to highlight and discuss the opportunities and challenges for financial institutions, consumers, and the financial system created by the use of big data and applied technologies. The event also provides a platform and opportunity for us all to engage with industry leaders, innovators, regulators, academics, to inform the strategies and policies that will guide us forward. Last month, we hosted our kickoff session that explored the potential uses of big and alternative data in banking and what that means for bankers and their customers. A video recording of the April 15th session is now available for viewing on the event website. Today, we are really delighted to be joined by the FDIC Chief Information Officer, Sultan Megji, who leads the first FDIC tech lab called FDI Tech. In this role, Sultan is involved in promoting responsible innovation at the FDIC and across the banking sector by actively engaging with banks, fintechs, and other stakeholders on several issues, including data, analytics, AI, quantum computing, and more. As we ask ourselves, what do new data mean for banks and consumers? Today's panel discussion will focus on providing policy and consumer impact perspectives on the use of big data and alternative data by financial institutions as they provide services and products. Our panelists today are three industry leaders in the fintech world who have all made significant contributions to the evolving world of big data through their work in artificial intelligence, machine learning, data analytics, research policy, and technology. Before we get started, I'd like to remind all participants to submit questions using the Q&A box on your screen. And when submitting the questions, please include your name and affiliation. All of the webinars are recorded, so today's video will be available for viewing on the event website within the next week. Also, just wanted to remind everyone that this is a 5-part webinar series, so please join us for future events. The upcoming sessions will explore the ethics of artificial intelligence and machine learning, open banking, and how we can improve financial regulation in the world of big data. So welcome, everybody, and I'll turn the program now over to Sultan, who will run the entire session.
Well, thank you so much, Sanjeev. I am incredibly excited to moderate this panel of three amazing individuals that have all had tremendous impacts. And I will just say that as the first Chief Innovation Officer at FDIC, this is one of the events I get to do where I am more excited to just sit here quietly and listen than to actually say anything. So with that, I'm going to turn it over to each of the panelists and allow them each to introduce themselves. I'll call on them sequentially, but first I'll ask Melissa to introduce herself. And I've asked all of them to also tell us about one interesting project they're working on professionally as it relates to big data. So I can't wait to hear that. So Melissa, over to you. And you're on mute.
Apologies about that. Somebody had to do it. Hi, everybody. I'm Melissa Coity. I'm the CEO and founder of FinReg Lab. FinReg Lab is a nonprofit research organization I established after leading the Office of Consumer Policy for 4.5 years in the Obama administration. And the punchline and the relevance for why I'm joining you all today is as we were sitting in government and engaging with our policymakers and regulators, both at the federal level, at the state level, and internationally, there were enormous questions around the implications of any particular data use, new or old, or technology use in applications in financial services. And what we didn't have at that time was any independent organization either inside government, and I think we're seeing more of that now, and Sultan is leading good work in that direction, or outside of government that with a non-advocacy hat could actually go out and engage in some of the empirical fact-finding information that is needed to ultimately inform how we are making sure that data and technology and the benefits that accrue to people, consumers, small businesses, and importantly, the market sector that they're able to accrue while mitigating the risks. And we know that there are lots of risks that we need to better understand. And so that's what FinReg Lab does. We have a couple of projects that I'm looking forward to talking to you about. I'll just preview something that we recently announced, and that is we are evaluating explainability techniques when it comes to using machine learning in credit underwriting, which is, I think we all realize, one of the most sensitive applications of more advanced and more opaque technologies in financial services. But so much of that is predicated on data, and we've done a fair bit of work on data. So looking forward to sharing more. Thank you, Sultan and Sanjeev, for having me. It's great to be back with the FDIC and this kind of convening.
Fantastic. Thank you, Melissa. I'll turn it over to Sarah now.
Sultan, thank you. And thank you for having me. It's always such a pleasure to be in the long shadow of Melissa when she gives an introduction. Her emphasis on the responsible use of innovation has inspired much of my work across the past decade. So I'm Sarah Biller. I am the Executive Director of Vantage Ventures. We're a new initiative, actually in Morgantown, West Virginia. And our goal with Vantage is we are fairly sector agnostic, but it's to bring the discipline, the capability, and the capital to rural America to advance innovation. We have a focus on fintech, as you might imagine, in that area because of the need not only to look to new products for financial security, but also economic mobility. I'm also the co-founder of the Fintech Sandbox, which, like Melissa, is a not-for-profit that works with very promising fintech entrepreneurs across sectors to provide them free access to high quality market data sets. And it's that area that I think I'm most passionate about. It's my heart project, the challenge I faced as a fintech entrepreneur, that being the access to data. And recently we've extended our work with entrepreneurs at the Fintech Sandbox, not just around capital markets, but also to extend and look for data sets that help us build new and innovative ways of looking at the whole category of sustainable finance. As we look to financial services and the power that we all hold, particularly in the banking, it's not only about the customer, but it's also that discipline that we can apply to solve some of society's greatest challenges. And so I'm excited and again, appreciate, like all will say, Sultan, your leadership here and willingness to have us on the panel. So thank you.
Well, thank you, Sarah, and I'll turn it over to Wendy.
Thank you, Sultan. It's so nice to be here. Thank you for having me. My name is Wendy Harrington, and I'm the Chief Data and AI Officer at TIAA. The company is 100 years old, and our core mission is to serve those who serve others. So namely teachers, healthcare workers, etc. And we take care of retirement, their retirement income. We have another important part of the business is Nuveen, which we acquired 5 years ago, and they serve institutions and financial advisors in terms of asset management. The project I'm most excited about right now is around ESG, so environmental, social governance. And we're doing more and more work to understand the underlying factors that drive the E, S, and G across equities, fixed income, real estate. And I think it's really a great opportunity not only to work and look internally, but also to engage our ecosystem. We have an ecosystem of fintech partners, academics, as well as leading institutions. And so we can pull them in on different partnerships. So a great pleasure to be here. Thank you.
Fantastic. I'm kind of in awe of this group. This is just such an interesting group of people. And while the FDIC, we're predominantly focused on banking, we're going to have a little bit of a broader discussion around financial services writ large. And so I'm going to actually come right back to what Wendy was just talking about. You know, ESG is a huge topic that's on everyone's mind right now. But one of the most interesting factors is how alternative data has fed into that discussion. And Wendy, maybe just let's double click on that a little bit and talk about how alternative data has driven some of that discussion.
Thank you for that question. It's such an interesting space right now. Everyone is trying to understand how do you measure E, S, and G through what lens? And in fact, earlier this week, I was at the Journal of Investment Management and talking to Roberto Ringabon on this very topic. There's so much noise in the measurements. And the question is, how do you get better at measuring it? And then what's the yardstick, if you will, against which you measure? Is it financial returns? Clearly, that's not, right, the ultimate goal of it. You would hope that if you do the right things on E, S, and G that you get there. But I think we're just in the early stages of figuring this out. So we're looking at a number of different providers. You can look at startups in the industry, folks like True Value Labs, who came in and took a different approach a few years ago that said, let's build from the bottom up. And they were looking at data sets around the world, some provided by government entities, some provided by independent firms, others were media, and trying to say from that, can we get better information, independent sources of information to pull it together? But you also need information from companies. A lot of that information isn't provided in traditional data feeds, right? It might be locked in a PDF that someone puts on their website or maybe published somewhere else. And so you have to take that through the lens. And then the question for a lot of it is, you might get the information on some set of companies, let's say the Fortune 500, but it's very hard to get it on a wide range of companies. And so what do you do? Same question for municipalities. We've been looking at, how do you measure the ESG for healthcare, for education, for water and sewer, right? And again, it's easier sometimes on the bigger cities, harder on the smaller ones, and very hard to get current information. And so I think so much good work has been done, but it's definitely a journey, and we're on the early innings.
Absolutely. And so I'm going to take that and feed it right to Sarah, because Sarah, you get to see what's coming, right? A lot of us spend our daily lives looking at what's happened in the past or what's going on right now. I think, Sarah, you have a bit more of a lens into what's coming, and taking what Wendy was talking about, what do you see coming down the line around alternative data?
Yeah, thank you, Sultan. I want to, though, pick up on a theme that Wendy mentioned. I think is critically important, and that is, to what end is the ESG data being measured? It was the preface for my last fintech company, Wendy, around fixed income, because we thought that the criticality here was to measure the risk embedded in and the widening of spreads embedded when you were able to collect and quantify non-financial factors. And so when we contemplate, on your question about what's coming, I think that we see things in a way that really make us wonder, of course, about the creation of data sets, but also the timeliness and the transparency. And I'm excited about actually the fintech community coming together and applying the tools. True Value Labs looks at over 10,000 different media sources. I think now they're up to 17 languages. And so they're covering that need for breadth of data, unstructured data, and timeliness, but also, Sultan, these teams that are on the ground, like OpenGov, who's actually going out and creating a digital environment for municipalities to share their data, to reveal what are sort of the current state, hoping to control their cost of capital as they go to the debt markets and otherwise. And so I think we have some exciting innovation that is happening right now. It's just not future state, that will allow for the transparency and the collection of timely data. And that also, we focus on municipalities, but it extends into corporations and, of course, like the Russell 2000. How are we pushing down into these micro stocks? And I think we'll see it.
Oh, absolutely. And you've said two of my favorite words, Sarah: risk and transparency, which then immediately makes me think about explainability, right?
Yep.
In the land of artificial intelligence, if you can't explain it, in many cases, you can't get it through the regulatory community. And this is where Melissa, lives and breathes. So maybe Melissa, let's take this and riff on it a bit, shall we?
Yeah, absolutely. So I'm frankly, I also want to just say how much I appreciate being a part of the panel and learning from others. ESG, those are such really important and complicated questions, how we get there, how we measure it. We tend to be really focused on the S, all right, the social implications of the data. And we come at this very much from really wanting to probe and understand the extent to which bringing in new types of data and new techniques for analyzing the data may be particularly instructive for bringing more people into our financial system. And while we have been really focused on credit because of all the sensitivities and the need for explainability, the potential of the data and the techniques is so important, even on the front end. Can you get into the financial system in the first place? And, the FDIC and the other regulators, I think, really did their best as PPP, for instance, was being unveiled and the resources were being made available to really try to drive encouragement of technology, fintech firms, and others to be on the front end, to be able to use data for identity purposes. Are these small businesses who they are, who they say they are, or are they fraudsters? And so it's got just wide applicability. On explainability, that can go in so many directions too. But we're moving from a world. All of us, I think, on this panel realize this. From, in many ways, I think the way that I sort of grew up as an econ major, right? Regression analysis, and we could understand the coefficients, and whether or not that was really sort of ground truth, it sure does make us feel good, right? In the ability to understand what a model is telling us. And now we're moving into this world where at least the academic literature and industry anecdotes and other insights suggest that more complex models, machine learning algorithms, really offer great potential to increase the accuracy for whatever we're trying to evaluate for. But yet, when we apply those models in areas, in financial services, we are all of a sudden in the position of needing to understand, and I'll get really concrete here, model stability. Will these models continue to hold as the data potentially shifts underneath? Can you explain it to yourself, to a consumer, what the particular outcome and the factor is that drove a certain credit decision? And then importantly, fairness and the past events, frankly, the events over many of our lifetimes and before, but especially over this past year, help to illustrate just how important it is that we are paying attention to making sure that we have fair systems and fair access to the financial system. And so a disparate impact assessment, you have to be able to understand what those models are generating to assess yourself for fairness. And so explainability, I think, it's something we might have even prematurely have taken for granted under more traditional ways that we conduct analyses, but we're all really needing to know and understand how much confidence we can have as we're using more complex approaches to analyzing the purpose of this topic, all the data that's out there. So happy to rip some more, but that's definitely how we're hacking this.
Yeah, I really want to take this conversation in two different ways, and Melissa, I'll let you guide which direction we're taking it. So the first is, it occurs to me that there are people listening to this who might not know what ESG is, and so I might ask all of you to give a sentence or two on that, and then I want to come back and link explainability and transparency into how we build equitable financial services, for the future. So maybe let's just do a quick round robin. Melissa, Sarah, then Wendy, give us 2 sentences on what ESG is and how you guys are thinking about that.
So we, again, really focus on the inclusion implications, the social side of ESG. And we come at this from an appreciation of how many millions of people in small businesses are not in our financial system, who frankly, with prudent evaluation, can and should be. So we really tend to hone in on the social aspect of ESG. I'll let others jump in on sort of broader definitions and how you all think about it.
Yeah, I can pick up, and I'll draw salt on something that Melissa said that I think is so critical for us to think about too, in this idea of equitable access to banking services, and certainly driving down to credit as one tool in the toolkit of banking. We always cared a lot at least on the fixed income desk about the residual. So you have an equation, you have an analysis, regression analysis, and you always had an unknown. And I want to remind everybody, we are in that big unknown. So everyone has a responsibility to help us kind of solve for the unknown here that resides. But for me, ESG, just very simply, of course, E stands for environment, S for society, and G for governance. And those are highly qualitative terms. E probably being the easiest to understand, and that's the impact that an institution or perhaps an individual or a process might have on the environment. But as Melissa rightly points out, S is super hard. How well do they treat society? And I think, Wendy, I heard you say some great ways to think about the S. And governance, of course, in a corporate setting means how well is the company behaving? Is it structured well? Is its board? But these factors aren't neatly tied in a spreadsheet like stock ticker data, someone's credit card transactions, and that's what makes it really hard. Yeah, but Wendy, you're right here in the center of it.
Yeah, I completely agree. I mean, we look at it through the umbrella of responsible investing. So how do you take the ESG into account when you're trying to evaluate a company? And every company is different. Every sector in which they operate is different. And so take something like diversity. You can take it in terms of credit. You can look at the diversity of your employee base. You can look at the diversity of the suppliers in your supply chain. And so I think that's where the nuances and the complexity come in. We can make good decisions in some component of that, but there are implications that maybe the unintended consequences. But I just love to see so many people focusing on this as a topic, because I think we will get better and stronger as communities and nations and as a world if we can take better care of all three.
Mm-hmm.
Well, we're in this unique environment due to the pandemic where there's a radical acceleration in the adoption of digital technologies in terms of consumers accessing systems like this. And I spend a lot of time worrying about, are we creating a new system of digital haves and digital have-nots? And are we, in fact, making issues with inclusion and diversity actually worse, right, versus making them better? And we've touched on this a little bit. We have this whole litany of things we're going to talk about. So I just want to touch base with each one of you on one thing, which is, what is something that you guys are seeing with alternative data that has a quantifiable impact to diversity, inclusion, or equitability that you guys are seeing right now? And Sarah, I'll let you start.
Yeah, I'll tell you what I'm seeing, Sultan, which I actually am super fascinated with and watching it carefully. And that's the rise of innovative techniques and, of course, technology techniques that are allowing us to aggregate historically disparate sets of data and apply them in new and differentiated ways. And I always spend a lot of time in the fintech community, so sorry for dropping a lot of fintech names today. But one of those companies is Argyle. And Argyle is going out and looking for points of disparate data sets that they can gather on non-1099 employees. So as we know, America is full, in other countries, but certainly in our case, full of gig workers, and increasingly so. And one must understand, how do we bank? How do we extend credit? How do we get to those individuals with high quality products and services if we don't have them on the 1099 like we're used to working with? So I'm excited about that opportunity to see the scale of technology and the long reach into otherwise communities of people who are making a living. They just might be making a living working 5 jobs as opposed to one, get access to our banking system. So I've seen that happen through COVID in ways that probably would not have been expected otherwise.
Well, I feel like we went from talking about a side hustle to side hustles, plural, very quickly, right?
We did. And it's the nature of our economy, right? Yeah.
Yeah. Wendy, I'm assuming you see quite a bit of this within your universe.
I do. I mean, one of the examples I'll give is a combination of fintech meets alternative data. Is a company, Correlation One. I'm an advisor there, but they started up to say, like, how do we solve the war for talent challenge on AI? And they started to look at how do you assess, first of all, the skills that are required, then how can you recruit folks who have those skills, and then how do you train? And as they were going through this journey, they realized that the percentage of women and minorities in the field is extremely low, 5-6% versus even kind of the 20% you might get in tech more broadly. And so they created a program called Data Science for All, where they're training women, minorities, those who come from or have been subjected to areas where they don't have the opportunities that others do from an income perspective. And they're putting through this training that's sponsored by companies. And so they get the training, they get exposure from a career perspective, and end up in jobs that, obviously have a good potential for growth. So I think there's so many different opportunities here.
Yeah. I mean, it's a fascinating challenge, and Melissa, you're quite forward from a regulatory perspective, right? You're looking at how we take this and apply it moving forward, right? You know, I obviously, as a regulator, can't comment on the future of regulation, which is ironic and funny. But Melissa, you can
you can have us do that, though.
Yeah, exactly. You're here to do that for me, so I'll just turn it over to you.
I'll give you a shout out. One, for having these conversations, and I think, you know, putting us in front of an audience of bankers and others who are really trying to think about where their next steps are in terms of the safe use of data or technology. And I will also admit that we're tiptoeing into this too in terms of the type of data that we look at. But you know, I'd say half a decade ago, maybe even longer, and it depends on your application, but looking at information that can be derived even from people's bank accounts and small businesses' bank accounts, right? What we call cash flow data, transaction information. And here I mean simply the financial picture that you're able to glean, not necessarily where did you shop or what did you buy. And that's, I'm sure we'll talk about that in a bit, but just simply the fact that so many millions of Americans and people in the US, as well as small businesses, have bank accounts where they may not have a credit history. Fintechs, half a decade ago, were beginning to really look at like how that data may be instructive for prudently credit underwriting people in small businesses. And so we decided to take a close look at those approaches, and we evaluated this transaction data for these basic questions that you, now wearing your regulatory hat, want to know. Well, actually, is it predictive? Does it actually help us, you know, bring more people prudently into access to credit? And is it potentially creating a disparate impact effect? Back to this fairness question. And there we found the data are predictive. In fact, they offer a nuance that your more traditional credit metrics don't offer for people who actually have credit scores or Vantage scores or bureau histories. The data are inclusive. We actually looked at fintechs who were able to underwrite simply using transaction data. And while it's always important to say, especially to any lenders in the market, you need to do a complete fair lending analysis, we looked at one of the most important questions, which is, are those variables correlating with protected classes? And there we found no, they're not. And that was really encouraging. And so I'll bring it back to you, the regulators. In late 2019, the federal agencies together issued a joint statement calling out cash flow data as a type of alternative data that really may have inclusion benefits, and regulated entities should be looking at that data, or at least you guys encouraged regulated entities to look at that data.
Yeah, as a regulator, I would hesitate to say we never like to say should. Like when
you wouldn't say should. Fair enough. It was an encouraging statement for sure, though. And more recently, we've seen the OCC, and I will commend the leadership over there. Even as we didn't have a political appointee in place, they've really been championing and encouraging banks and fintechs and others to get out there and test this data. And so we've seen that there are some pilots that are being unveiled right now, looking at this data for inclusion purposes. So really encouraging to see that kind of evolution. And I have to give the fintechs credit. I mean, to be fair, in small business lending, cash flow transaction picture has been insightful for decades and decades. But nevertheless, fintechs were out there leading the charge.
Well, there's certainly been an expansion around it, right? Yeah. And it was Sarah. Go ahead, please.
Well, I just wanted to ask Melissa a question. You'll forgive me. I think we're amongst friends. If I may, Melissa, have you noticed the rise in the subscription economy coming into the data? These repeat transactions. I'm so fascinated that we as individuals have almost put our financial lives on autopilot, where one can afford to do so. Yeah. So you have these repeat, transactions. I just wonder what that's going to do to the credit models. I don't know if anyone's thought about it. That's next.
Yeah, I was on with a bureau yesterday, not out of the US, but things like Netflix subscriptions as indicative of risk, which, you kind of scratch your head. I mean, that's also where some of the more complex models for understanding what this data may be doing that aren't necessarily intuitive to us. Like, wait, if it's on autopilot, why would we count that as indicative of risk? Well, perhaps it is. But yeah, I do agree. There are those questions, and I think there are lots of important questions around, opt-in versus opt-out around what data are being shared. And they raise questions around, well, how reliable will this information be? So put that out there. But yeah, it's a great question.
This cash flow based underwriting is a fascinating evolution. There's been some stuff in the news recently moving from small business activity, which has been around for a few years, to more consumer oriented activity. One of the things that I spend a lot of time worrying about is trust in the system. And in an environment like that, where there's opacity built into credit lending or any sort of credit decisioning, then you have the opportunity not just for the wrong decisions to be made or decisions that aren't in line with where we would like things to go, but then also consumers themselves, potentially those on the edges who we really want to support more and we want to make sure are trusting in the system, don't see that same trust, right? And that becomes a really big challenge. Wendy, I'll turn it over to you. Are you seeing specific sets of data that are useful as it relates to building more trust in terms of having more transparency in these kinds of decisions?
Yeah, there's a couple of things I would say. One is I was struck by Melissa's comment earlier, which I guess I'll paraphrase as the more we learn, the less perfect we realize we were. So we got so used to the models that we have, as imperfect as they were, and used those as a definitive, like, here's your score, here's your calculation. And I think as we move forward, what the alternative data is starting to do is it's showing some different results, and it's causing us to question, well, what were we missing before, right? And I think that's part of it. It's as we try and gain more transparency over time, as we try and get additional data, if we can do it as an and, say, here's where we are, if you can provide this additional information, or if we can get this, how does that change the picture? And then it's less about leaving people out, but it's another chance to bring the information in. I mean, from an investment perspective, one of the things that's along these lines is nowcasting, right? Historically, you took a historical information, you get a quarter lag or a 1 month lag. Well, during COVID, what we saw, and we all saw it on the COVID dashboards, right? You could get information almost real time. We took 50 data sets and pulled those together to get information on what was going on, not in the economy just broadly, but city by city, company by company. So whether you took mobility data from Apple and Google, or you took credit debit bill pay information from the likes of an Earnest, or you took open table reservations, you could start to see cities coming back, cities shutting down, and the impact that they were having on businesses and human behavior. And that all gave us a sense of, okay, so what are the implications for companies? And, the equation is always, you're trying to reduce the risk. So in this case, we're reducing the investment risk and trying to make sure we're delivering the returns, right, to help our participants and retirees. And so all of that provides more transparency into the picture. Was it perfect? No, but it was actually far more helpful than waiting on information quarters later or months later.
Can I jump in on that a little bit? Because I don't want to jump too prematurely, but I want to underscore just the relevance, and especially around timely data. And I think we're all increasingly realizing how instructive that can be, no matter what kind of evaluation or measurement or metric we're trying to assess it for. I think that's really important. I think, too, this question about, I think we can look back and realize, and Wendy, you spoke to this and I did too, that we got pretty solidified around certain data that we would use in certain methodologies. And we're at such an interesting nascent point when we're bringing in new types of data, alternative data, new methodologies. And one of the things that I'm really sensitive to, and frankly, I'm glad we're not an industry shop, but a research shop, is how do we make sure that we understand the full value that may come from the more complex math and the data before we start to set the really sort of hard rules of the road around what is acceptable and what's not acceptable. It doesn't negate the point that you made, Sultan, at the beginning, that especially, I will say this as a non-regulator, non-government person, regulated entities and sort of very heavily regulated entities are quite sensitive to making sure that they stay within their regulatory bounds. And that may be precluding some of the push that they may be willing to do. I think we need to pay attention to that. But at the same time, there's a lot that we just don't know, and there's a lot of good work to do to understand the value of the data and the, as I like to call it, fancy math that can be applied.
Well, Melissa, you've now opened one of the questions that I'm going to ask, because it's one of the things I wanted to learn from the three of you by the time we got to this. And I've asked this question of a number of people, and I've gotten, greater than the number of people I've asked a number of answers back. So you're
getting more nervous the more you add, the more you add.
So one of the things that I wonder about is, have the increases in data sources, especially these real-time alternative data sources, actually led to better access to credit across the spectrum? I think we can all agree that in very narrow pockets, we see very specific subsets of value being created. I'm curious about the overall system. I look at the entire American population and say, are we doing the right things to make sure that next year there are more people in the system that have the protections of the system, that have access to the right products and services? Are we seeing tangible value created there?
Yeah, I just join you in that question, frankly. I'm sorry. It's punting, I know. Others, you too, will have better probably answers for Sultan, but I think I'd love to spend some time with you to think about, like, how do we really empirically evaluate that question? But without prematurely landing on a policy position, depending upon what that answer is, because again, we're just so early days in, what the technology and the data may offer.
I don't have an easy answer either, but I would say that, part of this journey is not just access to credit, but, what's the interest rate? What can somebody afford? And how do you help make sure they've got the education and tools to navigate through that? And, very smart people making unwise decisions because they lack that information, right? They've taken undue risk. And so I think that's the tough one through it. It's not just access to credit, but it's access to credit at what cost and with what responsibility or implications for someone's long-term well-being.
Yeah,
Sarah?
Sultan, I'll come at it from the ground up. Just like nature abhors a vacuum, entrepreneurs are going to find their way when there's a gap in the system, right? And we've seen that probably to some of our chagrin, but others to our joy. And what you see for me is I see on the ground entrepreneurs who are fulfilling those credit gaps in responsible and reasonable ways. There's a fabulous young entrepreneur named Rodney Williams out in Los Angeles who has Solo Funds. Solo Funds is a micro lender, $25 at a time, and they're actually looking at new and differentiated pieces of information to help score independently those loans. And when you see that happening, you see those two parties meet, you wonder, when does the industry understand that there is a critically important business opportunity in serving these people? And technology lets you do it responsibly, to use Melissa's words, but at scale, and also return an adequate investment outcome. And so I do think that we're seeing it. It's just right now, it's unfortunate. This is not the right word to use with a regulator, but it's happening in the shadows. It's happening outside the system. How do we contemplate it in a way that uses those innovative individuals who are doing an incredible service? Otherwise, those people are going to go to those high cost non-bank products that keep people in these desperate spirals. And so I'm excited by where the entrepreneurial community wants to solve these gaps together. And you see it happening.
Agree, and not just here too, but worldwide. I mean, so much good work on impact investing to help emerging markets and communities around the world.
Yes.
Absolutely. And before we lose the thread on this, Sarah, you've highlighted kind of a key point to this, which is, the fintechs have been incredibly successful meeting the customers where they are. right? More so than a lot of traditional financial institutions, right? And that's something that I think, certain parts of the market have been slightly slow to adopt and to understand. But it does kind of make me beg the question just a little bit. Back in the day, you would have pawn shops or check cashers or, payday lenders or all these kinds of people. And those are the analog, those are the human to human versions. They're in the strip malls that people would walk by. And now it's digital, right? Now it's an app on your phone, right? And just as we see this tremendous opportunity for technology and this ability for it to really do things to positively impact, especially LMI communities, their access to credit, their access to good banking products and services, there is this kind of legacy, if you will, that we have to contend with as well. Sarah, I'm going to come back to you, right? And re-ask my question in a slightly different way. I'm going to keep asking this question over and over again until I get an answer. So do you think that fintechs have actually achieved providing greater lending opportunities to consumers?
I think not what's necessary to lift up out of poverty. I don't think we've seen that yet. I think we see a lot of shots on goal. But Sultan, I might, just because of the tick for tack, bring back the question to you. How would credit change if we actually were paying LMI people, which we have the capacity to do, when they do their job? What would change in our world of credit provisioning if there wasn't a 2-week lag on a paycheck? Yeah. And I think that's where, if we envision what the future is, it is a radically different question about credit. Because we have the capabilities to do it.
I'll actually take the question, take it a half step back at a slightly higher level, and then still refuse to answer it because I'm a regulator. But this is where real-time financial services is, the real key, right? If you can remove that air gap of 2 weeks or a week or even 12 hours in some cases. We've seen some amazing work in especially East Africa, looking at making real-time payments in the small business sector. They've been live for quite a while, and here it's we're still struggling to get that across the line here in the United States. Which gets us to, Wendy, your comment about the global side of this. And, one of the things that I've struggled with just as a participant in this market for so long is that in most markets, the United States is an exporter. We're an exporter of innovation. We're an exporter of technology. We're an exporter of ideas. In financial services, we're not quite as much as we are in other markets, right? If you want the best COVID vaccine, guess what? That's probably coming out of an American company or something based in an American supply chain. If you want, the best phone, that's again, the market's doing what the market's doing, but we're getting there. In banking, banking and financial services, we don't see as much exporting of American ideals, right? And American activity, which is kind of a fascinating question for me. But that gets to data privacy, right? And things like GDPR and data locality and things like that. One of the biggest concerns that I think a lot of people have is their data privacy, at a consumer level. Is my data my data? Do I own it? I'll start with Wendy, because I think you're going to have a unique perspective on this. Is what are you guys using alternative data for to protect consumer data and to make the consumers feel like they've got a good handle on what's going on with their data?
Maybe if I can just go back, because I think you made an interesting point about why aren't we an exporter of ideas and financial services, and I'll say a couple of things on that. One is, it's a little bit how the U.S. grew up. I mean, I remember when Check 21 came out, right? And it's, you could electronically use it checks, and Europeans were like, okay, like we're well past that, and so going into kind of the digital payment system. You look at my former employer, Figure. They just are rolling out Figure Pay, which is using stablecoin on the back of the Provenance blockchain. There's no interchange, there's no ACH, there's no wires, there's no fees, and it's instant settlement. And so I think as we're going forward, whether it's that, you see what's happening with the PayPals and Venmos, there's plenty of opportunity to innovate. Part of the challenge is the regulatory environment in some cases, and part of it is, the entrenched incumbents. It takes time. And if every state is a different regulation, that creates new challenges too. And I think the same thing comes back to privacy. It's challenging at our company, right? We are an insurance company, we are a bank, we are an asset manager. We operate in the US and in international markets. We have so many different regulations and rules. And so trying to think through like, what's the best way to support our customers in that? What's the best way to give them choice? What's the best way to make sure that they can opt in for what they want to opt into? It's not a straightforward. It's not a straightforward activity, and we're leveraging fintechs in that. You know, the likes of a security data.ai can help, but it's certainly a complex environment right now, and we're trying so hard to do the right thing.
Well, I'm going to jump right past your regulatory comments because I do not have the ability to alter the regulatory environment of the United States as much as I would potentially love to as a person. But I do think there's an interesting question set for Melissa and Sarah to say, you guys are, between the two of you, looking at identifying opportunities for the regulatory community, with Melissa and with Sarah helping to build that next generation of activities. You know, I think there are a lot of consumers out there who struggle to understand this changing technology landscape, who struggle to understand all the different moving pieces and the pace of fintechs. You know, PayPal and Venmo and organizations like that might seem very cool and interesting and very high tech, but you know, those of us know that that's not the latest and greatest thing. I mean, Wendy just highlighted one company that's light years ahead of many others in terms of their ability to implement technologies. And so the question to both of you is, you know, what are you seeing that will help consumers feel like their data is more private and then have some degree of comfort that it is, you know, being taken care of and being held more securely and done in a way that's explainable?
Sarah, do you want to go first, or do you want me to jump in?
Yeah, I have a contrarian view to what Sultan just asked, so you go first.
Okay. Well, I don't know that Sultan's going to want to hear my comment either, but it's an important one, I think, which is this is a place where policy making needs to be a priority. I was just on a call earlier today with the team out of the UK, the FCA, and hearing the extent to which they are thinking about household level credit decisions and the complexities that arise given the data that may be used and the technologies that may be used, all the way to macro questions around systemic risk that may be created, and really trying to sort of, I mean, Sultan, I feel like I heard you say this when we had our first meet and greet, right? Like really just trying to think about both ends of that and how interrelated they are because of the data and because of the technology that may be applied. So when I was sitting at Treasury and I would hear, oh, the US, you're so far behind, I'm like, well, you know, UK has they have many fewer institutions than we do. Like, give me a break. But I do now, I'm tending to join the, like, we have some work to do to catch up. And I do think now, to the privacy question, this does come back to really beginning to tackle consumer needs, consumer expectations. I mean, we have a 20-year-old law, Grant-Leach-Bliley, that, you know, specifies data sharing for regulated financial institutions. We have lots of open questions about all of these new actors that may be partnering with or counterparties to, but engaged in the provision of financial services. Are they financial institutions? Are they covered? Important questions there. And I know folks at the FDIC have been thinking about that matter, as have the other regulators too, but you know, it's upon us, I think. All the way to the other end, you know, Dodd-Frank, how many years ago did that pass? Over a decade, and we have Section 1033, but we don't have rules under it that help to articulate consumers' right to data and their ability to share it, which then, frankly, I think will provoke all of these downstream consumer protection questions around, well, how far can that data be shared? With whom, and do the protections flow? And how does technology potentially enable the data security and the data privacy, as the data might be shared between entities that are fulfilling really important dynamic financial products and services that people want? So lots to do there. I sound like I'm advocating, and we don't advocate, but we have done a lot of legal and policy analysis around these issues, and I think it's getting to be time. And we also have state laws that I think signal, you know, there's a real need, and there is value. I think many of us realize for having a federal set of privacy expectations. There's one more thing I want to add, though. I do think it's important to realize how unique the financial system is, and the financial system is based on understanding risk, which is based on data. And so how we then ensure that the advantages of data can be used, most effectively for that risk assessment, and making sure that we're not leaving people out. I think as we think about data privacy writ large, I think the financial system has its own uniqueness that's going to need to be probed. Hope that wasn't too long, but that's a little bit of what I think.
Well, I have a feeling that the other three of us all have about 37 follow-ups, but I don't want to get in front of Sarah's contrarian view.
Yes, right.
Well, I just appreciate it because I spend a lot of time thinking about privacy and trust, as particularly as we extend out the availability of data sets. And I just wonder if we're asking the right question of ourselves. This concept of privacy and data in particular is quite at odds with actually how we live our lives. If you think about what is being done, what we do daily, I have my phone sitting right beside me. I leave digital footprints 3,000 times a day, right? There is a pattern of us actually beginning to share data in a way that belies the question about how we treat privacy and what we think about it. And so I do wonder, and Melissa, I think you hit the nail on the head, how we maybe ought to be turning the question is, at what risk do we actually not manage individuals' privacy data? Because privacy is a two-edged sword. It can be used as a tool of protection and policy around privacy data. And if we look at the swing that's happening with, in other nation states, it's a means of control, right? And China is probably the most astute example of that, when you have full control over people's data. And so I think we do need to ask the question in the context of where we're heading in our modern lives, and ask it in the question of risk. And then also, I also have the opposite of return. What does it mean for me to have my data be mine? And so that's my view. I don't have an answer. I just have a question.
Well, it's interesting between the two of you. I in both of what you said, I wanted to instead of talking about the federated financial regulatory environment we have here in the United States as a negative, which I think a lot of people talk about it as a negative. I actually see it as a positive. I worry about hyper-centralized environments, not just from a control by a communist party, but also in terms of resilience and fragility. A friend of mine likes to say that resilience is about being able to take a punch and knowing that you're going to be punched and still, get on with your life. That's how the internet was engineered. One question though that came up in both of what you said that I'd love all three of you to go on the record answering is, should consumers own all of the data they generate?
Yeah. I'm happy to jump in on that one. Sorry.
I'm sorry. Can I ask Sarah to answer first, please?
Yeah, Sarah, sorry.
Well, I don't want to go first because I would no, but Melissa, if I may, Sultan, I would love to hear Melissa's answer. I'm still forming that thought. So yeah. Thank you.
Yeah, I mean, I've forgotten the question. I did hear the word ownership.
I asked if consumers should own all of the data they create on a daily basis. And I'll give you a great example. Okay. In the mid 1980s, the average American created, one, maybe two data points per day around their financial lives, right? They wrote a check, they paid their mortgage, whatever, right? Now we're doing one or two actions for 10 minutes. Maybe less if you start including geolocation data from our mobile devices and things like that, right? And that is I don't even think logarithmic is the right scale to talk about the differential, right? So we are creating as individuals a tremendous amount of data that has tremendous financial impacts, just in terms of basic activity all the way through credit decisioning, right? Should we as consumers, as individuals, own that?
Yeah. Thank you. So I have to give credit to my colleague, Kelly Cochran, who really leads our data work at FinReg Lab, and also Caitlin Askro, who has been thinking about this. She sits at the San Francisco Federal Reserve Bank for a while on this notion of data ownership. Is that really what we're trying to unpack? Or is it really about who benefits and what does the benefit share look like? because as we use the word ownership, right, that invokes lots of expectations in terms of, economic share, legal obligations. And so we choose not to use the word ownership as we think about this, but instead think about what are we trying to really understand and answer. I think another aspect of ownership that we mean when we use it is there's a dignity aspect to it, right? It's about me. It's respecting and understanding and recognizing my dignity as an individual. And so I don't know that we would go with ownership, but I think understanding how the benefits manifest to the individual and, in the context of financial services, how the benefits manifest in terms of financial inclusion, profit outcomes on sort of the provider side. These are the things that we need to think about. Ownership's a hard term, I think, to try to take on as we think about data in especially the financial context.
Yeah, I mean, I would just build on that to say it's not just ownership that's the question for me in that phrase, but what is my data? If I'm using somebody else's tools to do it, right, what do I own versus they own? Or as my kids like to say, if they're at gymnastics or basketball and I'm videoing and somebody else is in the video, is it that person's, right? Like I've just captured them in some scenario. So it's a very tricky, I think, path to navigate. What I would say, and I think what most people want is, where possible, may I have the choice? And where there's value in that exchange, then, I may opt in. I may say, yes, Waze, I'm getting value out of the service, so I know where traffic is now that, everybody's back on the road. And so that's an okay value exchange for me if I fully understand what they're using it for. Or if it's anonymized data, right? And some of the things that we were doing in different places for COVID tracking, right? If there was exposure, or if it's contributing, right, to the greater good, is there a way to anonymize it? So while it's my data in a sense, it's not tied back to me. So I think it's a hard question to ask, because I'm not sure it is the question to ask, because I think it's too black or white. There's so many nuances, and unfortunately in this one we can't simplify them away.
So I actually probably look at this through two lenses. One, the passive data we're creating that are feeding cross-sectional data sets, right? We talked about it, COVID exposure, from Gas Buddy being able to tell us how municipalities are doing across, gas prices and the health of the community. So I have a feeling that data is fragmented and not, if you will, mine. That gets contributed into a greater outcome, or yours. But I do believe there are places where individuals should own and be paid for their data. And I think it's where we see the criticality of their expertise and the creation of the data that only they can create to informing our next generation of machine learning and AI. And Wendy, I'm sure you're front and center in this discussion, but I can't envision an environment where, for instance, we aren't with autonomous vehicles contemplating what that means to the professional truck driver. Why aren't we taking their expertise and developing a means to pay them for the data they're collecting when they drive or when they're in some AR environment to improve our models for autonomous vehicles? They're coming. They're going to displace those drivers. They have the skill sets that the four of us don't, to actually build the right data set that's less noisy. So I think there's room for us to contemplate what it means to use your expertise to be a professional data producer where you get paid for, as opposed to what I just talked about when I pick up my phone and send a check through my Fidelity Smart Cash account.
Yeah, well, between the three of you, you've highlighted two different threads around this. One is fundamentally a question about risk and privacy around data, not ownership, which I appreciated hearing. The other is what I call amplification. There are a lot of people out there who in their daily lives are just trying to do what they're trying to do, but there's all this friction in their environment, right? And there are all these experts out there, and I would much rather have them spending 100% of their time being experts and not 75% of their time, fighting a system or wrangling data or anything like that. The truck driver example is a fantastic one, right? If we're building AIs to drive trucks, why aren't the truck drivers the ones, creating the data that system is trained on, right? But as we go through this, I'll link the two together, which is, when does that expertise and the data created of that, like, how do we think about that from everything from an ownership perspective to a monetary perspective, right? What there's value attached to that. How do we think about that? That's really not a conversation we're having. And obviously, as a regulator, I don't have an opinion on this, and these are only my views and not the views of my agency or any household plants I might have. But there is an absolute requirement for us to think more in a more future tense about this, which gets to prospective regulation and legislation. And in that case, there's a lot out there. There's everything from the CCPA to GDPR to a variety of other things out there. And I'm inside of an agency where I spend a lot of time looking at a piece of legislation from the 1930s, and so we have decades of work on that. You guys all have unique perspectives on this, and I'll ask Melissa to go last because this is actually her day job. But maybe Wendy go first. Where are some opportunities for legislative and regulatory innovation?
Simplify. I mean, I think that's it. There's so many regulations that cut across, and they compete in some ways. They're different in different ways. The timeliness, the more that we can simplify and standardize this, the easier I think it is for consumers to understand. I mean, let's just take this question of where a regulation applies. Is it apply because you're a resident of that state or country? Is it because you're traveling there at the time? Is it because the company's headquarters is there? What if, like, I just moved from California to Texas? The rights apply because historically I was there. I mean, from a consumer, it's hard to manage through. And then you have the lens of, is this because you're in a retirement account, or it's a bank account, or it's a non-regulated entity. So I think the more we can simplify, it doesn't just help the companies. I actually think it helps the consumers too, to understand their rights and how that plays out.
Yeah, I might pick up on what Wendy just said and just slightly turn it. I think, Sultan, there's enormous need for cross-agency regulatory bodies that extend across different data sets and different industries to come together. And the most obvious example of that is around HIPAA and our health data sets as it relates to our financial well-being. I think we all would argue that those are so interconnected, but yet held so separately. So how would we improve the lives of others if we were able to understand, again, responsibly, how health is intersecting with wealth, and make those decisions in a holistic way about the people, about individuals, and about our customers? I think if policy is to really drive us forward, it begins to think outside of its four walls of, I'm a bank regulator, I'm a securities regulator, I'm a HIPAA regulator. You are all responsible for bringing us together, and we have the data to do it. So that's where I think if there's a movement for policy, as Pollyanna as it sounds, you begin to cross aisles and think about it from different environments.
As a fan of Tolkien, I am a little unnerved to hear you suggest, the one regulator to rule them all.
Yeah, I'm not suggesting that. I am suggesting that there's some bridges that you all maybe think about building. Yeah, if I had to think about really where we go with policy.
Yeah. I mean, it's a fascinating environment because just from a financial regulatory perspective here in the United States, if you're an actor in this space, you're looking at 150 or so different governmental bodies that you're interfacing with at any one time, right? And that can be prohibitively time-consuming and expensive if you're a small company, and if you're a large company, the complexity can get even more. And then you add the international side of it, and it can become quite a complex entity. Melissa, you've bitten your tongue for the last few minutes, which I really appreciate, but I feel like I have to give you the floor right now.
I don't know that I have anything brilliant. I'm just really appreciative of hearing the different perspectives. I think I would join in the value of normalizing across jurisdictions. I mean, I think, there is real benefits ultimately to the consumers for that kind of outcome. But I appreciate what Wendy was saying at the start, simplify in some consistency. And so my next comment, I have to reflect and realize I've sort of just been in the financial sector for a long time. But when I think about how data is used for different purposes in the financial system, we have different protections and different definitions of, consent or no consent at all, in many ways for good reason, right? I mean, if you're trying to come into the system, are you who you say you are? We have Bank Secrecy Act, know your customer requirements. You do sign something, but do people really realize the consent you're giving to where institutions can go to gather information to verify your identity? I suspect not. Yet we're entering this new world with the value of data that may have real benefits across markets and consumer segments. And so I think it's hard. I think it's hard to sort of sort this out. And then I can't help but think about, one of my two teenage 16-year-old sons who, couldn't be more, my data is my data, and you better get my permission before you even think about going anywhere near it. And he's actually quite thoughtful about this, in some ways because of anxiety about centralized, power and control systems that could evolve with data access, where he's not consenting around it. So it is complex. I wish I had a more sort of artful answer, but I think these are the things we're grappling with.
Are there any useful guides to your point, Melissa, are there any useful guides out there? Is there anything that you've seen in this market or other markets that are useful guides for how we might start to mature our conversations just a little bit? So I'll highlight one example, and I'll cheerlead FDIC just a little bit here for 5 seconds. We've put out an RFI on a standard setting body, because one of the things that you want to be able to do is have data standards and data transmission standards, and the ability to say, listen, we're going to standardize our data on X, and we're going to start very narrow and expand, and that's a great place to start. It's so that at least you're having data in places where once you figure out what the regulation is, you can share it and do all the things you need to do. But are there any other guides out there? The thing that I highlight back is the founding of the internet, when we were designing things like TCP/IP and HTTP, and ensuring that there were open, standards around them that allowed the market, academia, and government to all kind of do their own thing within a common framework, right? Is there anything you guys are seeing, and we can be very broad in this discussion or very, very narrow in terms of alternative data, that you think is worth highlighting to the audience?
Well, I mean, we tend to really try to push these conversations by the convenings that we can do with the different stakeholders. And I think a guide for all of us is making sure that we get all the voices in those conversations as we then think about whether it's ultimately standards or even starting with principles, making sure consumer advocates, civil rights groups, people, and that you have obviously the diversity, socioeconomic diversity. I mean, make sure that those voices are represented in these conversations, I think, is an important place. I think you are putting your finger on some of the challenges that even sort of banks and other financial firms have, which is what are sort of their processes for standardizing the myriad, data that they happen to be sitting on and getting that clean and right and usable. And then what are they turning to understand how to do that well? I think these are some of the harder, it points to the needs perhaps for some guides in this space.
Yeah. There are no magic analogies or answers here. There are groups, though, like the FISD, right, within kind of the asset management industry. We're looking at, and they have created some alternative data standards amongst ourselves. What is it that we request when there's an alternative data provider coming? Because there are so many. I mean, just as an example, I think there's something like 5,000 different entities. Now, you can go to a marketplace to get alternative data. You can go to consultants who will advise you on which of the providers in the alternative space, right, can give you the best information on jobs or migration patterns or whatever it happens to be. And so, because of that proliferation, there are starting to be more standards, like let's agree on what we're asking for from each of them. So you don't have 600 companies asking for 600 different things. Same thing around things like web scraping, making sure that as we're looking through, we're asking the right questions of all of them, which hopefully will raise the standards that they're living up to, because they know everyone's going to ask them, what are you doing around these policies? So I think the more that, as you set up this group, Sultan, that we can think of those who have done it successfully, and how can we put in place some of those things that align incentives? Because I find anywhere where the incentives are aligned, you start to see movement together.
Mm-hmm.
Yeah, Wendy, I really think you're on to something when you talk about cross-company or cross-industry collaboration in a way that's compelling, and you have the right incentive alignments. Sultan, I think there's some lessons to be learned from the Federal Reserve banking system. If you would engage them in Boston, I don't know if you're allowed to do that, but particularly the Fed in Boston is a convening place for the major asset managers in town around cybersecurity risk. Where do we see and share information constructively on bad actors? No one competitively benefits by not having, knowing where their security threats are coming from. I wonder if there's an equally body that says there's certain data sets that if we came together, like Wendy said, and we shared or we knew about in the banking world, there's no competitive advantage for us hoarding that data. And so, though can't tell you where there's a nice analog or a playbook, I do think there is means for pre-competitive collaboration around data sharing that otherwise, we're going to lose out if we don't figure out that full data.
Well, Sarah, I'll say pre-competitive data sharing is that it's fascinating that you highlighted on that. In biotech and pharma, there's a tremendous amount of activity around pre-competitive data sharing and pre-commercialized data sharing. Everything from orphan drugs to just primary research. And it's led to the explosion in clinical genetics activity. It's led to the radical acceleration of manufacturing. So I think, you've highlighted, in parallel there, one area where we've seen some great activity that has, the regulatory community, government, academia, private sector, globally, all kind of aimed in the same direction, which is absolutely fantastic. I would like to ask the audience. Oh, please.
I was just going to jump on that because I want to underscore exactly what you've just said, and the fact that we don't have useful data sources to turn to, researchers, academics, nonprofits, and others, leaves a lot of uncertainty and insecurity as we then think about how the financial sector may be applying sophisticated techniques on top of it. And I think that's a really interesting comparison, and one that we should all be paying attention to, where there may be data sets that get created. We couldn't do the work if we weren't able to access the data that we are able to, but we are also sensitive to the fact that, it's a secondary use, right? And that's complex. And, we don't hold PII information, and we use processes to make sure that we don't gather that information. But nevertheless, if there are data sets, data lakes, synthetic data that is sufficient, that could be created for research purposes, I think it could really help to, leap some of the confidence and some of the understanding that, again, collectively, we've all got to get comfortable with when we're thinking about AI and ML and the uses of it. So,
yeah.
And Melissa, I haven't done it personally, but I know in some of the industries, particularly healthcare, people have taken the models and actually set them on top of other data sets to learn. So they don't really have access to information, but it can get smarter because of that. And I think there's a lot of opportunity there that we haven't yet tapped into.
Yeah.
When Wendy, we're sharing a brain, I was gonna go down a rabbit hole on zero knowledge proofs and shipping analytics around. But we can save that for a different webinar. We've been getting a lot of great questions from the audience as this has been going. I've tried to weave a few of them into the discussion. But if you have questions, please do submit them. And if it's all right with the panel, there have been a couple of really interesting questions, and I'd like to do kind of a lightning round on a few of them. And when I do lightning rounds, it's 2 minutes or something like that per answer. Melissa, I'm not staring too much at you. But I wanted to I wanted to go back to a question from Stephen, who's asked, and Melissa, please, since I gave you a little bit of trouble, please take this one first. How do you balance the need to disclose automated lending decisions in order to enable recourse and document correction, and basically as it relates to fraudsters? So how do you without digital identity, without common KYC, how do you kind of de-risk automated decision making in environments like this?
Well, I'll be really fast. I will say we're looking at that particular question in the context of credit underwriting. And we're evaluating a set of vendors that are offering the ability for rapid automated underwriting with machine learning. And there is an audit trail that is generated. And so having that kind of trail, I think, gives you then the ability to evaluate, if I'm fully understanding his question. But I'm going to stop there. Okay. I don't want to go too long.
Fantastic. Wendy.
Well, I would just say on top of that, to the extent you can provide that individual or small business back the reason for the decline and give them an opportunity to either rebut bad data or to provide additional documentation that might be able to get to the same point, I think that's where the learning and the collaboration really start.
Yeah. Yeah. Sarah, what do you think about this?
Yeah, very quickly. I just go back to the residual. What is missing from the decision that is unknown that led to that outcome? And I think we're a little ways away from having that explainability that makes people feel comfortable. So hold your data and tell why.
That's fantastic. So I'm going to paraphrase a question from Anne that I was just thinking about. And she was asking for us to give an example of alternative data. And I'm going to turn it just a little bit and say, you all have tremendous access to really interesting sets of alternative data. And obviously, in some cases, you can and cannot disclose it. But what's the most interesting bit of alternative data that you guys have run across in the last year or two that you think is interesting that might surprise some of our audience? Sarah?
I'll go first. I'm a big fan. We've mentioned Roberto Riccobon quite a bit out of MIT on this call. I'm a fan of his colleague, Sandy Pentland, who also is in the MIT Media Lab, and his work around social physics and really gathering momentum data, how we move around cities and towns, and applying that to new forms of credit lending and gentrification is really fascinating. And so it's out there and available, and we can talk about it. But his new book is fantastic on these alternative data sets. Yeah.
Excellent. Wendy?
Yeah, I don't know that it's going to surprise and delight, but we're trying to get at some of the underlying questions like migration patterns. Mm-hmm. Where are people moving from and to, and what is the infrastructure in those places to support them? And to the extent there's opportunities to invest, that's interesting. So you can take, for example, ADP data and try to understand from the employee and the employer perspective, who is moving from X to Y. You can also take cell phone data, so geolocation data. They start to look at and say, okay, where is this person from 8 to 5? Let's call that work. Where are they overnight? Let's call that home. And then where do they frequent? And you start to get interesting patterns of where people are going and why. And then again, understanding the migration. Both so you can help from an infrastructure perspective, but also understanding things like housing prices.
Yeah, I'll go quickly. I thought Sandy Pentland's work is amazing, and I think I would join you. That's pretty provocative and interesting to understand what they're doing. In the credit space, there is work out of India looking at your mobile phone and not just your payment activity. It's looking at your network, your contacts. How long do you stay on the phone with people? How big is your network? And the research out of Gupta, I'm forgetting his first name, shows it is indicative of risk, which is interesting. I don't know that it delights; it might scare, but I still think it's worth being aware of.
Yeah. Sultan, if I could add to Wendy's real quick, one of the best investable signals we've seen in our models is the one-way rider truck rental.
Yeah. We looked at that.
Now all the value's been traded out, but it is a fascinating data set. Yeah.
Well, that's a data set I haven't actually looked at. Now I feel like I'm out of the club. I didn't know about this.
What happened during COVID with one-way rentals of moving trucks? Yeah.
But I wish I had something cool. I'll answer my own question. I've been looking at census data. That's my big exciting piece of data. And, we have this Get Banked initiative and looking at some of the metrics. I always like understanding, like if we're looking to change something, like measure it now, and then you do stuff, and then you kind of do your A/B testing everything and figure out what you changed it to. So that's my big thing right now. Let's talk very briefly. This is from Zach, and he's asking the hot question that we heard various congressmen ask in a bunch of different ways yesterday as well to my chairman. But what are your guys' thoughts about preventing bias in algorithmic decision making? And I'll ask. I'll flip a coin. Wendy can go first.
Yeah, so I have to start with, understanding where we are today. So I think we've all seen the models that are in use today absolutely positively have bias, right? And so whether it's hiring, right, and we continue to hire the same people with that same kind of protocol. And so part of it is saying, are we starting to make steps in the right direction? And let's make sure we're at least making incremental improvement on it. The second thing is just recognizing, like, what are we doing to dig into the data, to understanding the biases that are there. Some of the ones I think people, they check off the list pretty quickly on one or two factors, but there's more than that. And so really having a diverse set of folks looking at it. And by diverse, I don't just mean diverse from a racial or gender, but different backgrounds, right? So like what other things could be in this data set that we're not thinking about? And then the third is, sometimes it's a little bit of that experimentation. If you bring in a couple of other data sets and it starts to change the model, you might go back and think about why it changed it. And are there biases that were in there that these alternative data sets either teased out or otherwise attenuated?
Melissa?
So I would join Wendy on the last one in particular. We are looking at some of the approaches in machine learning, including adversarial debiasing models, where you basically are having one model compete against the other for your, optimizing for outcome profit, but you're minimizing your risk of, differences between protected, non-protected classes. Academic literature is raising questions of, would we actually end up in better outcomes if we use protected class information in the models themselves? This is empirically an interesting question. It's got lots of complexity. It is illegal to use that data. We all know that. But from an academic research standpoint, I think that's an interesting matter. And ultimately, to Wendy's first point, what are the data you're using? I mean, most all of the research is pointing out just how important it is to make sure that your data set is comprehensive, especially as you're using more complex models and representing the broad population you're trying to understand, so that you're not ultimately training models on data that then are insufficient and ding populations who you otherwise, would successfully evaluate, and they're not being harmed either by price or by access.
I'm really a student here. I'm like taking notes while they're talking. I have to confess. I think it is such an important topic for all of us to begin to be really well read on and understand the implications, because the sophisticated modeling and the application of AI is not going away. And so, Sultan and everyone, thank you. I'm actually taking notes.
I would like to raise, like, it's a different kind of bias, but so much of the tools that we all use are logical ones, and there's so much behavioral bias that we as humans bring into the equation. I mean, we're even testing a model or capability to identify human bias in decision making in terms of portfolio management. Right? Do you hold on to your losers too long? Well, yeah, there's loss aversion, there's recency bias, right? Are you late? Do you have a blind spot for this country or this sector? And I think in financial services, part of the reason that people make bad decisions sometimes is that human nature, right? Either the FOMO or the greed or the impulse to go and make a decision now. And so I think that's another type of bias that maybe we can actually use these tools to help us uncover about ourselves.
Yeah, and maybe the answer is to how we talked about Sultan, how you led us down the idea of thinking about learnings from the pharma industry for financial services. Is there lessons in our modeling from the social sciences, which historically have had to unpack these very nuanced but interrelated factors that our modern portfolio construction techniques, in the case of Wendy, or banking models, have not had to look at that interplay so distinctly and say, you know, the classic example of a Bayes estimation technique, when they analyze children's academic performance. Is it the child? Is it the teacher? Is it the school? Is it the region? These are the questions we must ask ourselves, because we have learned we are interconnected with all of these things.
I couldn't agree more with that. And while it's great to see a renewed focus on STEM within the educational system, we can't leave the humanities and social sciences behind. And Sarah, just as a reminder to you and everyone else, this is being recorded. It's the only reason I'm not taking notes, because I know I can come back and quote and all of you later.
Yeah.
We have one question, and might be our last, depending on how long it takes to answer, from someone named Sanjeev from SCU. He said, it's good to hear that variables used in lending models are not correlated with protective classes. If you had to recommend, I might regret asking this question. If you had to recommend to the regulators one metric for measuring bias in lending, what would that metric be? And then the second question is, do you think that metric would be different in any way as the industry moves away from moving towards transactional data instead of demographic and other state data? And Melissa, you've got some help.
I don't think you can isolate. I mean, I think this is one of the most important aspects, the dynamism of the data you're using and how you evaluate for lots of different bias. I mean, there's statistical bias, there's, prohibited racial bias. I'd love for there to be a simple answer. I think that's what the research we're doing now is going to show. It's not so simple. And it's not just the machines. I mean, you have to have humans, and you have to keep calibrating each against each other.
Wendy?
I don't have a wise answer on this. What I will say is that I think some of these come back to kind of human characteristics and traits. And it comes back to, we did some work years ago, and it was about who was responsible. If you could tease out in different questions, just get that answer to that one question, super high, you could say correlation, or I don't know, causation to someone's FICO score. So, right, if they're responsible and feel accountable to that perhaps is the strongest predictor. There's a lot of noise in the data for sure, and a lot of factors that I think are correlated with one another.
Sultan, I'm going to turn it back to you to wrap us up. Those were incredible answers to a complex question.
Yeah, this in the last 90 minutes, if I wasn't sitting here in this seat having to do the conversation with you guys, I'd be furiously taking notes, and I would have spent a couple $100s on various online stores to buy the reference material cited, because it all sounds absolutely fascinating. So here we have just a moment or two left, and I'd like to start by just thanking all three of you for this absolutely wonderful conversation. I think I and the listeners are just, we're so fortunate to have the three of you as key leaders in this space, and I thank you so much for your time over the last 90 minutes to educate and enlighten all of us. With that, I'd like to give each of you a chance to just say one thing, and then we will sign off. And I will just say, Sarah, go ahead.
Yeah, I am excited about the future and what we can do to strengthen our banking sector through these conversations. I think it looks a lot brighter than it did to me this morning. So thank you.
Fantastic, Wendy.
I think it takes a community, it takes an ecosystem of people coming together. And so thank you for the opportunity today.
Yeah, I'm frankly encouraged by the regulators in particular, the federal and the state regulators, who are really trying to understand it. I mean, discussions, leaps and bounds in terms of interest and appreciation for what the benefits may hold, but how you really have to understand the risks too, to get the regulation around this right. So thank you. It's been a pleasure to join you all.
Well, again, thank you all so much. Thank you to everyone who's been listening to us today, to our latest webinar. As a reminder, this will be on our website next week, and we're as a recording. We're incredibly excited about this series, and I can't wait for the next ones to come. And I encourage all of you to keep it on your calendar and listen. I hope they're as good as this one. I think they will be. Thank you all so much.
Thanks, everybody. Bye.
Thank you.
Bye.